It is often observed that every year or two, a different asset class comes up in the performance ranking. Sometimes it's equities, sometimes gold, debt markets, commodities, real estate, and even Bitcoin have all gone through purple patch periods and also times when they were miserably out of favor. So in this video, we shall explore a category of funds called the multi-asset or asset allocation funds, which seek to manage portfolios with a combination of asset classes. More specifically, we shall look at what are multi-asset funds, what are these different asset classes and how they are chosen, the benefits and the shortcomings of these funds, how has been the performance, and most importantly, should you be investing in multi-asset funds? As the name suggests, a multi-asset strategy combines different types of asset classes to create a broadly diversified portfolio. These asset classes often include stocks, bonds, commodities, gold, and more recently, fund houses have started to add international equities and real estate to their portfolio mix. The rationale behind using different asset classes rides on the fact that every asset behaves differently during various economic phases. Over the last 2 decades, this weak or negative correlation between Indian equities and Indian bonds have been seen during the dot-com crash, the mid-2000 bull run, the COVID-induced fall in 2020, and the post-correction recovery. In a similar fashion, gold and equities often move in opposite directions. So while equity needs economic growth and expansion to flourish, gold tends to do well when the economic outlook is all doom and gloom. So to put it together, the USP of a multi-asset fund is around ensuring that your investments are not at the mercy of a single asset class, and if one asset is struggling, the other parts of the portfolio can compensate and do the heavy lifting for you. In fact, multi-asset funds are often marketed as an all-weather portfolio, which is another way of saying that these funds can deliver balanced returns at low risk in all market conditions. And having said this, yet another asset that delivers exceptional value under all conditions is the ET Money YouTube channel. So if you haven't subscribed to our channel or liked this video, then kindly do so, as it really helps us with the YouTube algorithm. While I can't speak for others in our team, I for one have been a skeptic of marketers. I mean, they show us these colorful brochures and these tempting taglines like all-weather portfolio, but the brains of a financial product is always in the data. And to understand the math behind it, we decided to put this all-weather portfolio to the test and examine how 4 different asset classes would have performed on an individual and a combination basis. We do this by studying the last 15 years of data for 4 different asset types: the Nifty 50, the Nasdaq 100, the Nifty 10-year G-Secs, and the domestic price of gold. Additionally, we have also created a very simple equal weight multi-asset index where we have taken 25% of each asset type, that is 25% of the Nifty 50, 25% of Nasdaq, 25% bonds, and the final 25% is gold. Okay, now that's a lot of numbers. So let's bring the understanding of this entire table down to 2 important metrics: the risk or the volatility metric and the returns metric. Let's start with volatility. After all, an all-weather fund is expected to deliver relatively stable returns irrespective of whether it is raining or shining. Our data here shows that our reconstructed multi-asset portfolio does what it is supposed to do and offers a much lower volatility as compared to 3 of the 4 assets in isolation. In other words, our equal weight portfolio has a lower standard deviation when stacked up against domestic equities, international equities, and gold over the last 15 years. The second metric we examined in our study is the all-important performance metric. And for this, we looked at returns across different time frames, that is, over the last 5 years, the last 10 years, and the last 15 years of observation. What comes across from this assessment is that our makeshift multi-asset portfolio has done better than bonds and the Nifty 50 in all time frames, and has often trumped gold over many years. The point is, and I'm now wearing my marketing cap, is that our multi-asset simulation does a fairly good job in terms of returns over the long run when compared to the 4 assets in isolation, and it does that with a rather low level of volatility. Of course, one should note that we have used a 25% weight for the 4 asset classes, which might not be the case with how multi-asset fund managers operate. Different schemes use different asset class combinations and different weights in line with the scheme's objectives and how fund managers view the prevailing business cycles. The point will get more clearer in the next section, where we evaluate some of India's most popular multi-asset funds. The multi-asset category in India has about 20 odd schemes, most of which are available for purchase on the ET Money app. A quick peek at the data shows that the average multi-asset fund does an excellent job of giving consistent and stable returns when compared to the average fund in a standalone asset class. However, the real problem with multi-asset funds starts when we look at the individual schemes within the category, and that's because not all multi-asset funds are created equally. What I mean is, unlike say a large cap fund where 90-95% of the assets need to be invested within a defined set of 100 companies, individual multi-asset funds have a lot more flexibility. In other words, these schemes can invest into different types of assets, invest in companies across capitalization, use different types of debt instruments, etc. to achieve their objectives. Most of the funds are built around 3 main assets: equities, debt, and gold. And it is only a few fund houses like Nippon India, Tata, and Motilal Oswal who have allocated reasonable money to other asset classes like international equities and commodities. Now, one of the reasons for sharing this table here is for all of us to appreciate how different the approach of each fund house can be. For instance, Motilal Oswal and SBI are not leaning much on equities as of now, while fund houses like Axis, ICICI Prudential, UTI, and others are still high on equities. As an investor, this understanding of allocation is important, as it will give you a better insight of the risk levels and the investment objective of a particular fund. In fact, one of the impressions most people have is that a multi-asset fund is ideal for conservative investors, which we now know might not be the case, as every multi-asset fund has varying scales of riskiness depending on their allocation to different asset classes. And it's not just the asset class which can be different, but sometimes even the holdings within a particular asset class can be starkly different. For example, within debt, some fund houses are conservative and prefer to have their money in short duration paper and in Government of India securities, while some of the aggressive funds will go with corporate bonds and even riskier investments to extract a better yield for the investor, although it means taking a higher risk. From an equity perspective, while most multi-asset funds invest in large and mid-cap companies, we found the Quant multi-asset fund to be a bit different. After all, this fund has a huge small cap and mid-cap company bias, with not even a single large cap company in its top holdings. Now, you might be thinking that I'm trying to confuse you, but in reality, what I'm doing here is trying to narrow down the possible areas of confusion to 2 specific areas that you need to focus on. A, the percentage of allocation per asset class, and B, the holdings within an asset class. But if you think this is hard work, then do explore using the ET Money Fund report card, which gives you not only the rank of each scheme within the multi-asset category, but also gives you other specifics like the scheme's performance quality and its level of downside protection, all of which come together to help you make better fund selection choices. Multi-asset funds are designed to make life easy for an investor. And from what we have seen so far, these funds do have their benefits. After all, they deliver stable and long-term returns, manage risk through asset diversification, use the services of professional fund managers, and respond tactically to market changes. In other words, multi-asset funds position themselves as a one-stop mini portfolio so that the everyday investor does not need to pick multiple funds in different asset classes and can simply pick one multi-asset fund. But having said this, these funds also have some glaring drawbacks. The first drawback is that your return expectation cannot be too high. A high single digit or a low double digit return is probably the best case scenario, so about 8 to 12%. Secondly, there is always the possibility of a misalignment with your desired asset allocation. What this means is that these multi-asset funds are not personalized for you, which means your risk tolerance and how the multi-asset fund is structured might be totally different. For instance, you might be comfortable with 40% in equities, so you are a conservative investor, but it's still possible that the fund you have might have 80% in equities. So to put this together, in our opinion, having a portfolio that incorporates multi-asset classes is a good thing, but then there are two ways of getting there. One, you can choose a multi-asset fund which has some benefits and limitations as we mentioned above, or two, you can use a combination of funds like a large cap, a mid cap, an international, a gold fund, etc. to create your own custom multi-asset portfolio. In our opinion, the first approach, that is using a multi-asset fund, can be explored if you are very new to investing and have not built your acumen of diversifying with different assets. But as you start understanding how to invest, how different assets operate, and once your portfolio starts growing after 3 to 4 years, we think having a specific multi-asset fund might not serve your needs, and it will be in your interest to invest in a portfolio of funds and do your own asset allocation and rebalancing. This way you'll have more flexibility, more control, and you're more likely to balance your risk levels and your investment objectives. And with this, we come to the end of this video. Do subscribe to the ET Money YouTube channel, tap on that like button, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.